Facebook.
And hello and welcome back. David Kinder here, your host of the Financial Advocacy Podcast with our co-host Mike Moffat and Curt Gibbs. Welcome back, guys. We're doing a different time slot now. So now we're at Tuesdays at 5 p.m. Central, 6 p.m. Eastern, 3 p.m. Pacific time, because maybe we'll all be together at the same time. But glad to have you guys here at the same time. This is a different topic. Curt, you mentioned this idea of these secondary annuities to me. I don't remember when, maybe 6 months ago or so, maybe longer than that. And we just hadn't gotten around to having a webinar or anything on them. Uh, Tell me a little bit. How did you find out about this stuff? And then introduce our guest who's going to give us our presentation here today.
Yeah, absolutely. First, I'm really excited about what we got coming on the show today, and with Nathaniel and what he's able to provide to us with some information that I don't think, from an advisor perspective, I don't think there's too many people that have really heard about these products and how they work. And I was first introduced to them. I guess Nathaniel and I've been doing things together for probably, I'm going to say 8 or 9, maybe even close to 10 years now. Time kind of gets away, but I did some research on this product and this line of business, and it's a niche market. I think that fits a lot of advisors if they'll take a look at them. And we'll just let Nathaniel speak to what he can share with us about them. I'll make a little introduction here, and we'll kind of go from there. But yeah, I'm excited.
Yeah, and the neat thing is that, like with the rest of the audience, whoever is chiming in with us today, I'm going to ask questions as we go, and I'm going to ask the questions that just come to mind. And that's the neat thing about being the host on some of these things, is that I get to ask any question I want. So let's bring them on. Curt, you have a proper introduction? We just bring him in.
Well, just bring him in, and I'll just start talking about him. I won't want to steal any of his light, but Nathaniel Pulsifer with DCF Exchange. We're going to talk about secondary market annuities, a market that I think, for sure from a client perspective, has probably never heard anything about. And it's something I think everyone who's serious about guarantees with their money and wanting to get the best bang for their buck, so to speak, should definitely take a hard look at. Nathaniel does a great job at explaining how these things work, and really how simple it can be. But without anything else, I'm going to let Nathaniel take control and just walk us through how these things work. And I hope everyone that's out there tunes in at some point, whether you're an advisor or a client that's looking for some kind of vehicle to give you guarantees to take a look at.
Cool. Hey, thanks, Curt. Thank you, guys. It's a pleasure to be here. Very cool.
Yeah, glad to have you. And I'll have questions as we go. But please, I know you've got a presentation. I do not see it here, so please share your screen, and then I'll add it in.
Yeah, you bet. You bet. No, so as Curt said, these are that what we're going to talk about are some folks call them secondary market annuities. They are payment streams that come from annuities issued in conjunction with structured settlements. And so let me get my screen shared over to you guys here, and we can go through it. And
there we go.
How's that look? Does that look good, David?
That looks good to me so far. Let's make sure our technology actually treats us right.
Yeah, I think we got it. We're all smart folks, and so's Curt. He's been using these for, like he said, 10 years. Using these in a variety of ways with client accounts. That what's so cool about this business is that in the 2-cent summary, I deal in period certain guaranteed payment streams, meaning term certain, 17 years, 22 years, 19 years, 8 years, whatever. Just a very specific number of years that a payment occurs, and it's either a monthly payment, an annual payment, or a single pay lump sum. All of these payments come from structured settlements and awards that individuals have had in lawsuits that they want to sell their payments in the future. And so what's really cool is working with guys like Curt and you guys who have planning scenarios that are really hard to solve problems with traditional annuity or traditional insurance tools. And I can come in and be like, hey, I got a solution for that. I can plunk a payment down right in the time period when you need it to happen. That can be for IUL payments, or it can be for for retirement income, for a bunch of things. So you're going to pepper me with questions, David. Let me give you the 2-cent summary real quick on our on what exactly these are, and then we'll take it from there with any questions you got. So I call these DCF payments, discounted cash flow payments. We've also used the word secondary market annuities, but a secondary market annuity is a pretty good term. But there's a lot of things about an annuity that come with certain guarantees, certain protections, certain contractual rights, as well as state level restrictions. Guys in New York can't buy the same thing that somebody in Connecticut can buy. So I try and stay away from the word annuity. Also, kindness of our friend Ken Fisher, who's kind of made it a toxic word sometimes. So let's just go. It's a discounted cash flow payment. It comes from an annuity, and I'll get into all those specifics here in just a sec.
Well, we're not afraid of any controversy on this show, just so you know. We will take them on.
Good, just so we know. Well, he's done a good job of making consumers excessively hyper paranoid about annuities, and it's really too bad because annuities are awesome. They do great things. They're a great safe money tool that make retirement income portfolios work, and it's really too bad that as an industry we don't fight back against one guy with a big old ad budget. But that's a topic for another show. So
we've covered that show.
I bet you guys have. I touched on it just in a couple of different ways here. Secondary market annuities is a term that some folks use. DCF, or discounted cash flow payments, or wholesale income payments. They're period certain, term or a number of years. They come from structured settlements. And when an individual who has a structured settlement, which is a monetary award for personal injury, when they want to change up that award that they had got that settled their underlying lawsuit, they can't just call up MetLife or Berkshire or whoever the underlying insurance company is that they get their payments from. They can't just call them up and cash it in. They have to turn to a secondary market for somebody to buy their future payments. And everybody's heard the jingle, I have an annuity, I need cash now, from JG.
I was just about to bring that up. I was like,
exactly.
We all have that in our head right now, and I don't mean to put the earworm in.
I will save you the agony. I won't sing it.
Appreciate that.
But that's the world that we're in here. JG is the biggest. It's the only real consumer or household familiar name that people would have. But it's a real small industry. We're talking about $600 or $800 million a year in total transaction volume. It's a really small industry. So that doesn't rise to the level of a bunch of companies being able to compete for ad time, especially in an election year. Advertising, TV, or anything else is really expensive. So being a small industry with a high level of competition among factoring companies, most people haven't even heard of this space, be it consumers or even structured settlement recipients. That's a $6 or $8 billion a year of new issue structured settlement, and we're in sort of a stable run rate now as an industry where about 10% of this year's issuance at some point in its life cycle will be factored or resold. So I kind of think we're a nice stable industry. It was a lot more common maybe 10 years ago, 2012, 13, when there was a lot more transaction volume in its early days, but now it's sort of on a good, solid, stable run rate. So bottom line, people who have payments that need to sell them can't just call up and take a surrender fee. They have to go through a secondary market transaction where these transactions are regulated in every state. Every state has Transfer Protection Act laws for the consumers, and the IRS lays out strict guidelines that we follow. So transactions go to court. There's court orders that assign them. And I don't need to go into the details of the safety levels of these. They're extremely safe, guaranteed payments that are transferred basically by non-appealable court order in the transfer process. And that's what my company specializes in, is being a buyer in this space. And we distribute through advisors like Curt and others who are kind of in on this. Unfortunately, this slide is from a couple of weeks ago when yields were a little higher, but now Jerome has taken us down a notch or two. You'll still see some 6% yields, but the bottom line benefit is that you can get the same benefits that you would get from a period certain, let's say a 20-year, $1,000 a month, like we're showing here. It just is at a higher interest rate, which means a lower price. Price and yield move opposite to each other. Concept that's really hard for people to understand. So I can either say save money on your guaranteed income or get a higher yield. Either way, you end up with the same thing. But this is trying to illustrate that $1,000 a month for 20 years. I could sell that for $141,000, or you could walk in the front door of an insurance company, and at the time of doing the slide, that was $152,000. So $11,600 savings, just higher yield, lower price. I touched on what they are. These are payees who have to sell their future payments. To do so, we have to follow IRS regulations and a court-ordered process. And I've been doing this 14 years now, 14 years. I've probably handled north of $500 million of future payments, several thousand transactions. I've got some of the best lawyers in the country that review every single file and watch out for it. So I set my whole business up to make this as easy and streamlined for advisors like you guys and for your clients to know with utter certainty that what you're getting and how you're getting paid and how it fits into your process. A little quick visual here.
Real quick, I did get this question, and Alonzo, he's my favorite, and my brother from another mother. He always chimes in. He thinks he heard right. You said these are period certain payouts, so these are not lifetime annuities. These
Correct.
Are period certain.
Yep. Period certain payouts. And you've seen that if you've quoted a SPIA, for example. Like if you quote a client for a SPIA, it's going to have a price, and it's going to have a variety of different pricing options. If somebody needs $1,000 a month, they might get it for $90,000 for life only. And then it might be $105,000 for life with 20 years certain, or $103,000 for life with 10 certain. That's where most financial advisors or insurance guys kind of come into the term period certain. With a structured settlement, we're dealing with people of all ages who've had injuries that are settling their injury claims for typically a very long time. The rest of their life, they have some repercussion from their injury. Let's say you get hit by a car and you can't work. You're making $5,000 a month before, and you can't work now, so you got to replace that income. You've got kids that need to have a guarantee that you are going to work another 30 years. So you've got a life with 30-year kind of claim against whoever hit you with that car accident. That's a very typical kind of a settlement. So somebody, and those numbers get big. I mean, settlements are $3, $4, $5 million is really kind of run of the mill. When
we look at life insurance as a protection vehicle, when we think about, let's suppose you're the breadwinner of the family. Mm-hmm. He gets hit by a car and mm-hmm. is killed, and of course, and it's a Budweiser truck. Are you going to sue Budweiser? Of course you are. How much are you going to sue him for? You're going to sue him for the most you can get. And then of course we say, well, I'm confused. Why don't you have that much life insurance on your husband in case he dies in bed? It dies of illness or something. So, we bring up that dichotomy, that cognitive dissonance in that decision-making process. But yet this is where we're talking about the actual lawsuit. Something happened, and it was a real thing where they're liable. We got the cash flow awarded by a court, but then needs come up. You can't necessarily wait for all the cash flow for everything. You've got other things that come up. And like the jingle says, you need the cash now. So you look for a company like yours, and they're going to sell those structured payments over. Yep. And then you do what you do. And then somehow you're going to do some sort of arbitrage to help us get better things for our clients.
Let me back you up just. Yeah, you made it make perfect sense. Let me clarify a little bit of the role here that I play. J.G. Wentworth is what's known as a factoring company, and there are probably 30, 40 factoring companies in the country that specialize in structured settlements. These guys have a tough job. They have to find people that want to sell their payments and then get them on, to sell them and get that legal process moving. They have to perfect the payments, meaning make sure that they exist, work with the insurance companies, get on the court docket in the domicile or in the jurisdiction where that individual lives. So those factoring companies put the deals together. It's a tough business. It's a real scrappy business. I don't love that business. I'm not in that business. Okay. But I depend on those guys in those business. They are my vendors. They are the people I buy from. Those companies put these transactions together, and shortly before they reach a point of certainty, when we go to court to get the transaction approved, they assign the whole bundle of paperwork over to my company. So it's XYZ Factoring Company puts it together, works with Bob, who got injured, strikes a deal with Bob, puts him under contract, gets it to court, and then they assign it to me, and I agree to buy it. My company is a capitalized intermediary. So I have millions of dollars of capital that I can actually stroke the check to buy the payment stream when it's approved. And that's a huge value add for Curt and his clients, because he can go with certainty. That's what we're on the right slide here. I'm the second owner of the payment stream. The first owner is the guy who was hurt, and then I buy it. And I actually stroke the check for the individual who has sold his payments. The factoring company makes a profit at the point of my purchase, and then I can turn around and resell it through my the business structure that I put together, and through my partners at Gold Star Trust Company, who's a trust and self-directed IRA custodian, as well as banking service escrow company. They are the payment servicer of each of these payment streams. And when I resell it to, let's say, one of Curt's customers, Gold Star is an integral partner in that. They run the escrow that Curt's client would send money into a specific numbered escrow account. They handle each payment from the insurance company. If the client dies or wants to reassign it, or has an heir that takes it over, Gold Star does all of that post-transaction policy service. So it's really nice to have a strong third-party custodian there in the middle of the payment stream. But I only stepped on your comment there, David, for a second, just to clarify that, I'm not the factoring company in the transaction, but we're the sort of the financial intermediary, kind of like the bank in a way for factoring companies. They'll send their deal flow to me. I buy what I can buy, especially if it fits a current client scenario. And we'll get into that in just a minute, of how to, how I mix and match. That's the value I add. It's like, hey, here's stuff that's in stock. And then you come to me and say, oh, I need to lump sum in 2044. I make that happen and go find it in the marketplace.
There we go. And the way that all of that, because that's overhead and everything, but the way that's paid for is by how much everything is discounted to the person that needs to be cashed out. Because somebody's got to get everybody paid, and to be able to offer a higher yield, to like, wait a minute, something's off here. Where does the money come from to afford all that? So
exactly. So the first owner in this slide here, the person who sold, they do sell at a discount. When they sell through the factoring company to me, they're taking a haircut. Sometimes, in a tight market or a low yield environment, it's not really that much of a haircut. Like they were, a couple of years ago, some of these discount rates were there's a lot of capital chasing yield. So it was a good time for sellers a few years ago. Earlier this year, interest rates spiked up. So discount rates, when they go up, the amount sellers would get went down. So transaction volume went down over the last 18 months or so. Sellers didn't get as good a deal, but my buyers, Curt's buyers, we got great deals because our yields were higher. So we just move in lockstep with the market. I'm sorry, I'm putting my hands up in front of me here and realizing you can't see them. If rates go up, the rates then come back down again. Right now, rates coming back down means sellers of payment streams will be getting more and more dollars for their payments if they choose to sell. But I can still deliver a higher yield than the new issue annuities that are really my comparable apples to apples comparison. Stuff like a MIGA, multi-year guarantee, fixed annuity, or a period certain SPIA. So it's a good deal. I wouldn't be in business if it wasn't a good deal for my customers. And my customers are the guys like Curt, who have clients who need a higher yield on their income. And so, when rates are going up quickly, it's a different story. I can be caught, in a rising rate environment. It can be a little scary to have some inventory that might be underwater 6 months from now. But, thankfully that was a couple of years ago. That's behind us now.
So let me show a couple of comments here. We got use the term when speaking of 401ks versus lifetime annuities. We're talking about period certain versus lifetime annuities. But this was a really good question. She'd be here. I'm really glad he's here. He's my associate from Alonzo here. So what if the guy doesn't die and his accident settled for $1.5 million, 10 years? How does your company work? Is that how it works?
Quite a few questions in that one sentence there. If the individual who had an injury and settled for $1.5 million 10 years ago, presumably the settlement included income and some sort of an income stream. If he wants to sell, as I said before, he could sell those payments through a factoring company, and I would potentially be the buyer of those payment streams. A lot of the stuff gets sucked up into securitizations and sold on Wall Street, sold right back to the insurance companies and pension funds as big securitized bond offerings. But I follow the same business model. I just sell the individual payment stream to an individual investor. So that's how my company works, is that I'll buy a payment stream from one party, warehouse it for a little while I distribute it through Curt or another financial advisor, and then it goes to their end customer. So I can track my payment through the whole life cycle. And that's why it's a real interesting payment stream for an advisor, because it's an insurance product, but it's not an insurance product. It's a receivable that's got a higher yield, but it's not a securities product. There's no risk element to it. There's no commingling of funds. It's purely fixed business. And it kind of falls outside of the lines of securities transactions or new insurance transactions, because it's an existing insurance payment stream, but it's fixed. It's not going up or down in value. When my customer gets the payment stream, or your end customer gets the payment stream, they're getting a guaranteed payment at a guaranteed yield.
Right, and it does not contain securities. It might be traded as a security, but that's completely separate from the client's end experience. Therefore, we do not need securities licensing to offer and sell these things. That's what I see as the regulations there.
Yep, exactly. So I can wrap up real quick with a couple of benefits of these payment streams, and I'd love to run through many more questions that you have. For advisors and their purchasers, where there's virtually no fees whatsoever. There's the purchase price is the purchase price. There's no ongoing costs or AUM fee or charges or anything. No volatility. It's what you see is what you get. I can work with IRA or non-qualified funds, and we don't have buyer suitability restrictions or long drawn out forms and things like that. I can work with people of any age as well, any age, any state, because it's a fixed receivable, which is an advantage over. I'll give you a real quick example. I've worked with an advisor who wanted to have some money set aside for a 17-year-old and have it mature when he was 25. A lot of ways you can do that using a trust, or you can do this, you can do that. But he chose to use my product, and we just did like 7-year lump sums, and they made an investment, and it matured when the kid was 25. You can't do that with an annuity product at that age. It's a 17-year-old. So
right.
And one of the nice things about these over a lot of annuities with the yield is that I'm dealing with companies like MetLife. I'm dealing with companies like Berkshire, New York Life. Like, we're doing the best of the best. We're not in the C-rated or the little carriers you've never heard of. It's really only the big carriers that play in the structured settlement space. Pacific Life, really the A-rated high Comdex score companies. So a lot of name recognition in these. I already mentioned the benefits of buyer age restrictions.
If I could go back on the suitability part there on the previous slide here, because one of the things that's becoming increasingly a problem, at least I'm finding that out, is that annuity companies, especially the index annuity companies, they're far more afraid of, I'm going to say, bad public relations, overzealous advisors. Therefore, they've got these onerous suitability restrictions that basically you have to have so much more liquidity and such in order to get a certain amount within their product. And like, you know what? Yeah. I'm the judge of what the client needs and should have. Why is the insurance company trying to say how much you can put in? And sometimes we're lucky to find another pot of money I didn't know about. But the thing is that the company is saying, we'll allow you to put X dollars in, and they're limiting how effective I can put their product in. Now, I thought we were in the selling business. I like the idea of letting the client buy as long as they know all the terms, conditions, fees, and the whole thing, and it fits. So let's talk about that. How does that relate for your company? Does it almost not matter? I mean, I love the freedom and flexibility for me as an agent to be able to say, we can put, let's throw a number, 90% of your funds into this thing, as long as you understand the terms, conditions, the fees, and everything else.
I'm really glad you mentioned the as long as you understand part. And Curt knows me well enough to know that, I don't want to come across like a cowboy, right? But we could do 100% of the client's assets if you wanted to, but I don't know anything about your client. So I really rely on professionals like you, David, to say, I know where your situation is, and it would be completely safe to put more assets into a fixed payout stream. I looked into doing suitability forms and suitability kind of questionnaires, and I worked with my lawyers on it, and I said, who's the judge? How do I know what's suitable? It's not. I can have 10 pages of forms for two questions. I still will never have the client's full financial picture. As you said, there's always another pot of money that they don't tell you about. And I just said, it seems like I would be opening up myself to a lot of liability as a product supplier to try and fake it till you make it, say that this is that this is suitable or not. So I don't want to be glib about that. I think there's a real value in suitability requirements and helping people understand. Here's a good example of suitability. Somebody comes in and they have $100,000 in an IRA and they put it all into a 10-year lump sum. Well, they're 75 years old and they have no cash to pay RMDs. That's unsuitable. Somebody, the advisor or the client themselves, always need to be aware of RMD requirements. You can't go into a fixed income product with no cash flow with RMD requirements. So there's a role for suitability, but at the same time, the client who has only $500,000 and they need lifetime income, they really should be able to put all of that into lifetime income. Otherwise, they're highly at risk of running out of money in retirement. So suitability is a tough one to answer. There's like many things, I think that there's a value in the suitability restrictions that some carriers have put out there, but it may be very hard as a planner to suit. So when I run into those situations, I'll always recommend to an advisor, go ahead and place your primary annuity first. And then what do you have left over? If the client has a limited means and they need lifetime income, buy the lifetime income so they can't outlive it. But then if they love the safety and they love the guarantee and they want another layer of guaranteed monthly income, come to me for that second tranche. And we can they can buy another 10 years or 15 years of income to layer on top of that lifetime stream. Then they have their back end covered with dollars they can't outlive, which is hugely valuable. But then, frankly, most people are going to spend more money in their first 10 or 15 years of retirement than their last years. So layer on some guaranteed income in those early years after you take care of that back end longevity risk.
Right. Well, at the same time, I'm also looking at it, and we talked about in the very beginning of being able to fund life insurance. Mm-hmm. Now, when we're funding a fixed premium, I need to be able to have a fixed liquidity amount each and every year. So here's the thing, and not too many people will go into this kind of detail. There's a difference between, we were talking about a 10% free withdrawal, right? Mm-hmm. Which is available in every single annuity. The problem is that it's usually based on the 10% of the anniversary value, right? If you have $500,000 in an annuity and you take out $50,000, now you have $450,000 left. What's the 10% of $450,000? It's $45,000, not $50,000. And so in order to come up with the difference, you'd have to pay a surrender charge on top of that to make up that difference if you're going to do it. So I've found very, very few annuities that are based on the original contribution amount to be 10% level. And I'm always looking for, and other than SPIAs, of course, I'm always looking for where I could find that 10% level or just a set amount of income that I can rely on, because I'm in California. We arrest annuity agents if you screw it up. You know?
I know.
I am not playing here. You know, so anything I could do that keeps me and anybody else out of trouble, I want to make sure I do. So is that something almost regardless of age? So if we can take essentially the onerous suitability out, meaning the overreach of companies that are trying to protect themselves. I get it, but I don't like it. And yet I can use a product that can help structure these payments so that we can accomplish what the client wants to accomplish. That sounds like a win-win-win to me all the way around.
It's a total win-win. And there's so many situations. Once you get your clients to think about, instead of thinking about the product and what it might do, I'm going to borrow a line from Stan here. Don't buy it for what it might do. Buy it for what it will do. Get your clients to think about what exact outcome they need. And I'm in the outcome business. I can give you a guaranteed outcome. A great client, Brent, also a California resident, came in last week and said he's in his mid 70s. He's got an early 60s wife. Real typical scenario of my best kind of clientele, because lifetime income products don't work for the older man because it's based on the younger woman's life, right? And their payout rates aren't great. Brent came and said, and he's bought quite a number of these payments from me. And he said, I want to get another $30,000 a year for Deb for, I'm going to be dead, but it'll be 2031 through 2035. So no problem. I went through my list. I picked out 5 or 6 different payment streams that accomplished exactly what he was looking for, put it together in one bundle, and we settled that one out today, as a matter of fact. So buying $30,000 a year in lump sums that are going to pay to his wife after he's dead, he could just kind of take that out of his brain and take that worry off of his mind and say to her, put a stocking stuffer and say, I got you covered for another 5 years, honey. Those are situations that, I realize I digress from our conversation about suitability restrictions, but
that's what we're going to do.
Yeah, it's outcome. It's defined outcome planning that's a little bit different than what most people are accustomed to thinking when they're saying, all right, you take your 10% withdrawal, the market may go up, it may go down, but you should have at least this much. Those are all kind of future variables. There are a lot of clients who say, I don't want any variable, even if it's in a FIA that has no risk of loss. They want to know exactly what they're going to get when they're going to get it, and that's a real specialty for us. It's this defined period certain outcome. So
well, and I'll jump in here and say this about this is what I kind of gravitated to years back with Nathaniel, and what these income streams are able to do is we're all in the fiduciary business. We've had that conversation from several podcasts or conversations later. You've got to do what's right for your client, and this is that one product I feel like that from registered rep days of thinking of that accumulation phase of money, this kind of satisfies both sides of the mountain. It gets you, it takes care of the accumulation side, and then once you're there, the distribution side, it's really sweet, which is really what you just spoke to there. It just complements a lump sum of money or a situation. Both directions. I feel like that it's a great way to ladder money for those that get the concept. We've done that with several of my clients, some repeat customers, as you mentioned, and it's a beautiful way to create the value that I think really the pre-retiree or the person that's run into a lump sum of money is looking for. It takes the pressure off of having to worry about what are you going to wake up to and find out tomorrow when the market opens up?
It does. It definitely takes that pressure off. And Curt, you couldn't have teed it up better. I'm hoping that this slide really illustrates for you guys like the different ways you can utilize this for that accumulation phase, for that distribution phase, or for specific client needs. You can utilize these assets in all of those different ways. Like Curt, you've had a lot of clients that have IRAs and they're in their mid 50s and they know they're going to retire in their mid 60s. So they've got safe accumulation as their goal. So they don't even need the supplemental income. They go for those zero cash flows that mature in either as lump sums or as deferred starting incomes out years in the future. Then I have clients like like I told you about a minute ago, who had, wanted 5 years of income for his wife starting 6 years from now. Very defined planning needs there. And so that's income later, if you will. So there's a lot of different ways you can use these guaranteed payments to satisfy client goals. And you just got to get them to think about it and vocalize it. That's where the real skill as an advisor comes in, is getting people to start visualizing where they want to be in retirement. Where do they want their income to be coming from? What truly is their risk profile? People don't have a real good conception of what their risk profile is, I don't think.
Yeah, I think you're exactly right about that. We've had this conversation before, and every time I've ever, called Nathaniel, we've had a discussion about a potential case. I feel like I kind of speak to the fact that I really try to find out what your client wants, and give that message to you, relay that on to you, so that you can get a better understanding of what you have that's available and what may or may not work. And it's a communication between us and you and the companies that you work with that really make these things really perform, I guess, and provide. Not really perform from a rate standpoint, but we know that is what it is. But it does give the client the comfort of knowing that I was looking for this and I was able to purchase it with fewer dollars because of that discount that I wasn't able to on the open market. Because if they've done anything at all, they're gonna look at a couple of different ways to generate the income that they're looking for. And 9 out of 10 times we can customize these things and make these payment streams work. And you do I pat you on the back for that. You do a great job at making Thanks. These things, do what they need to do and pay out the way they need to pay out in the time frame that a potential client's looking for.
Yeah, that's great. I appreciate that, Curt, because they do pay out just as your clients want them to pay out. If we know the goal is going in and the clients understands, can vocalize what they want. I tried to, I bought life insurance. I haven't sold it to clients, but I bought it, and I tried to take a line from life insurance here. Buy term and invest the difference. Buying term income and investing the difference in your retirement income.
That's great.
Instead of getting people to say, "Well, I could leave it in the market, and it might go up and it might go down, and my retirement may be this and it may be that," and they hold on to all that worry and all that risk. Just buy a term or buy a period certain income stream. And if you can guide clients towards that visualization of what a fixed income, it doesn't need to be a bad term. It's not a 4-letter word. It's a good thing.
Very true. I got a couple of questions that came in. Yep. What is the minimum pour in, and if so, what is the minimum? And then the other one is, what's the average amount that's put into some of these things?
Well, I've been very, very fortunate to have great clients and advisors like Curt. I think we perform a little better than the average annuity agent. My minimum, for minimum size, I'm dealing with discrete receivables, meaning I've got payments that are a variety of different sizes. So I'll do, occasionally I might have something for $5,000 or $10,000, but I think my median average ticket size is probably $100,000. And my average client is probably $500,000 or more. People even who they come in and say they want to do a $50,000 deal, before you know it, they've done 3 or 4 of those or 5 of those, and then they buy a big one. I'm selling to people here in 2024 that I've sold to in 2011. They continue to reinvest. They like, once they're in the market, they're in it for the long haul, which is an awesome thing for the advisors. It's not a one sale done and gone, and then a lot of buyer's remorse about the poor performance of your variable annuity or the FIA. They do exactly what they say they're going to do, and then they come out, get the lump sum like you're seeing on the screen here of a couple of example payments. They get that lump sum and then they reinvest it in the next thing, especially if you buy a ladder of these payments. So to answer your specific questions, if there's a specific dollar amount that you have that you need to invest, I can cut a payment stream down to size to suit that. Remember I said a few minutes ago, all of our payments are handled by a third-party escrow company. Gold Star Trust Company handles all the payments from the insurance company. So I'm not in it. It's not a blended or securitized or any kind of common pool. It's a single escrow account. And you don't have to buy 100% of that escrow account. You might buy, in this $108,000 Bright House case, for example, you got $10,000 to invest. We can make a $24,000 payout, just 10% of this particular one. That's easily administered by the trust company that handles the payments. And so I can make a tailored outflow to the amount you have to invest. We do that pretty frequently with remainder balances in IRAs, for example. People maybe have a cash flow. They're not taking the distribution out of the IRA. 35,000 has accumulated. And I'll get a call from an advisor and say, I got 35 from this guy and 27 from this guy. Can I put those, can you create something from your inventory to suit those and use up those dollars rather than having in idle cash? And for advisors who take the time to understand the market, the second part of your question, David, was, what's your average ticket? This product or my business or one of the two or the combination, we seem to attract really smart, wonderful customers who have pretty decent net worths and a high level of understanding. Once they understand the market, they tend to buy over and over again. And it's been very rewarding. I love working with people I've known for a long time and know their kids and their grandkids, and, and to be able to keep working with them for a long time. Once they're in, and they feel like, they're in on a little bit of a secret club. You started out in the intro saying this is a market that nobody knows about, and kind of a crappy marketer, I guess, because it's not.
Well, you can say goodbye to those days. We've got you. We're getting.
You got my back.
The
big thing is getting people to think about what outcomes they need. What's that defined outcome that you want, and it's not I hope the market makes it through my retirement. There's no hope and dreams with this stuff. It's just, this is exactly what you see is what you're going to get.
Yeah, so we're getting the great comments. Terry Roxy's a great advisor out of Florida. Thank you for tuning in, Terry. Alonzo asked another great question. Is there an age range, or can it be offered like an education IRA Coverdale? You talked earlier that you did it for a 17-year-old, which is wonderful. As long as they know what they're trying to accomplish. It sounds like as long as you can put it together, the sky's the limit.
I have not found, and maybe one of your advisors can help out here. I have not found a way to do the equivalent of a self-directed IRA where you can buy all different kinds of assets, to do a self-directed 529 plan. I've had people ask for it, and I don't think you can do a 529 in alternative assets like this. I think that's what Alonzo had asked. Can you do it? And it's a great funding asset for college, but I haven't figured out how to do it with actual 529 restricted dollars. And when I get grandpa who wants to do something for the grandkids for college, we just do it as a lump sum, non-qualified, pay it directly to the kid when they mature, whatever that is. It might be 18, or maybe they do it after college. Let them have their debt, and then boom, something appears from grandpa when they're 25 and helps them pay off their debt.
529s are a different animal altogether. So but the Coverdale, maybe that could be done that way. I don't know enough about that. But 529 plans are always sponsored by the state, and it's usually with a favorite annuity or a mutual fund company, and there's other considerations with that. So just go to non-qualified. Makes sense. We do probably 30 to 50% of business is qualified IRA dollars, and the rest is non-qualified. And so, I've tried to go out into, like I said, 529s and various different esoteric sources of capital out there, private accounts with annuities and, managed funds, managed accounts and stuff like that. But the bulge bracket right there for my 60-year-old, getting ready to retire is a sweet spot for all of us. Perfect. Yeah.
It's another thing too that, as from an advisor perspective, think out, I kind of did this, several years back, working with Nathaniel, is think outside the box of things that you can do for people that you may not be able to do with traditional planning, the kind of thing that we know is a huge myth with a lot of different products out there, and one of those things is just like a trust, setting up putting this, using dollars that someone has to put into the trust. We got one of my cases that they set up a trust for the family and did it that way. Another one that I keep trying to gained some traction on is I have a large homeowner association in my area that has several dollars in a homeowners association fund, and they, periodically they have to put roofs on and they do things like that. What a great way to maybe even, put money into that and have laddered income coming out of it at certain times to provide those benefits for a homeowners association, or even like a church to pay the pastor. There's all kinds of things, if you'll think outside the box, that from traditional planning, that these things really fit a need for.
Yeah, you're absolutely right. And homeowners associations is a market I've always thought these are perfect for those long-term capital reserve funds, because you see so many reserve studies in an HOA, for example, will have unrealistic yield expectations for the last few years, that accumulating cash and think they're going to make 6% a year on their cash while just sitting on it. And then, for years they were underperforming. Well, they could get that kind of yield in a fixed asset that would mature right when that roof is fully depreciated and needs to be replaced. So these are great assets for that kind of a need. But getting a herd of cats on an HOA board to agree. Let me know how that works out for you.
Yeah, that's the challenge.
Yeah, that's a tough one. Individuals are a little bit better able to identify their goals and come to a common ground. But that's a challenge we face with any sale of any product, is getting all the stakeholders in the room at the same time to come to the same conclusion. How many sales are torpedoed by a spouse that wasn't there the first time around? Best to get them on the board at the same time.
So I got another thought that occurred to me, and I'm just throwing it out there, and the answer is allowed to be no, but I'm going to ask it anyway, because one of the things is that annuities are not typically used for business planning. Okay. They don't like it. That's why, they usually don't get the tax deferral treatment, stuff like that. But companies are allowed to accumulate more funds, let's say for a buy-sell agreement, and they will need to retain more capital than what they're allowed to. It's called the accumulate earnings tax. But if they have a certain reason to accumulate more earnings, then, like funding a buy-sell for someone who's uninsurable, that kind of a thing. And I'm just starting to think, I wonder if this or something like it can be adapted for that purpose, which also means I get to earn another sale commission for helping a client to be able to find another way to accomplish their goals.
Okay. So remember on my very first slide, I said this is, DCF Exchange is my company. DCF, discounted cash flow. Curt introduced me as, with secondary market annuities, but I said, you can call it a secondary market annuity, but really it's a receivable. This is a payment stream receivable. It's backed by an annuity, but you're not actually buying the underlying annuity contract. So this is for consumers, that's a distinction without a difference. You're still getting a payment from MetLife, right? It's a periodic payment that comes from a great credit. But from a tax standpoint, and I don't really want to get into it here, I'll be out in front of my skis, but I'm happy to share with you guys on another session. It's not really an annuity in the sense of the restriction that you were just alluding to from a corporate ownership standpoint. It's not a new insurance contract. And I think it's going to sound a little bit like Bill Clinton here. How it comes down to, what's the definition of annuity? What is? Your
definition of is. Yeah,
exactly. But I don't mean to be glib, because the annuity is it is a contract with an insurance company, and it has meanings in the IRS code that maybe Mike and I could talk about some more as well. But what I'm selling is a period certain payment stream backed by payment from a contract coming from one of these big insurance companies. But from the IRS or from a pure economic standpoint, it's just a receivable without, it's a receivable that's going to come to you on a certain date by contract. So I see no reason why you couldn't, and I don't really know the corporate accumulation tax. I'd be way out in front of my skis on that one. But I think there's no reason you couldn't own it.
Something there that at some point we'll formulate something, maybe do a case study on, whatever.
Yeah.
I'm just thinking that it goes around the annuity restriction for corporations, and at the same time,
acts just like one.
We get it acts just like one, and we can get paid again. Look, as you can tell, we are not a nonprofit organization. We keep saying that over and over again. But at the same time, if I could find unique ways to help clients solve more problems with the same dollars and help them accomplish their goals, and I get paid multiple times, I don't see a downside here of any of
Not
them.
at all.
So.
Not at all. And to that point, like creative uses, like using it as a corporate funding asset, using it as a funding asset for a pension that a pension fund may own. Curt alluded to this earlier too. Using these assets as a way of accumulating premiums for 10-pay or 7-pay life insurance. These are great assets. You certainly get paid again doing it. I mean, you're going to sell a life insurance policy, but if you can sell it to your client as here's a single transaction that buys you a funding asset, that buys the life insurance, and if you die after 1 year, you still have the funding asset. You didn't give up your premium. It's made money along the way. Like that's a win-win-win all around. People get more and spend less for it.
Perfect. All right. Alonzo asked another good question. Do funds need to be liquidated to transact with you?
Yes. Now I'm going to say there's one big thing that people ask that I keep running into a block on, and that's 1035 exchanges.
Okay.
I know how to get them done, but it's, the price tag starts at about $3 million before it's worth doing for an individual to go to a private placement variable annuity that is the wrapper that then buys my funding asset. And that comes with AUM fees, and that comes with all kinds of other costs. So clients who come in and say, can I cash in my $50,000 annuity over here and buy your thing for $50,000? It's a taxable transaction. You got to cash it in, liquidate it, and then buy me with the cash. That's for non-qualified or for funds in an existing annuity. I cannot accommodate 1035 exchanges. And the reason, again, you're not actually buying the underlying insurance contract. A 1035 exchange is a transaction between an insurance company and another insurance company, much like two IRA custodians, right? It's a custodian to custodian transaction. The IRS law is specific about that. It's not like a 1031 real estate exchange, which can be just like-kind exchange of property. 1035s are much more, and it has to do with LIFO too, their tax treatment and things like that. So I wish I could, but I'm fairly certain that answers his question.
Yeah, I think so. And then he asked one more here, and he says, does Grandpa face gift taxes if he sets up one for his grandson?
I don't know enough about gift taxes to answer that.
Fair enough. And I don't have that information at the top of my head either. And doggone LIFO. Yeah.
Exactly.
Or FIDO. No, okay.
Or FIDO. Yeah. I don't know enough about gift taxes. Frankly, it's something I'd like to understand a little bit more about, but I don't know enough about it to speak even illogically, so I'll stop talking.
Okay, fair enough. Yeah, we don't have to pontificate outside of what we're thinking about.
One other thing I want to touch on before we finish up today is Nathaniel, could you tell everyone a little bit about the fact that these are somewhat liquid even after purchase. I think that's key to understand. I mean, everything has the pros and cons, but take us through that.
Yeah. So there are pros and cons for sure. This, like anything, it's not for everyone, right? So it's definitely a higher yield fixed income, but liquidity we talked about 10% free withdrawal. If you're relying, I used to work with a guy whose whole business strategy, and it was a good one, was to use FIAs without any of the income riders or any of the other bells and whistles of index annuities, just a straight up accumulation vehicle. And if you need income, use your 10% free withdrawal. And if your index annuity didn't do well 1 year, don't take it out of there. You take your income from some other bucket. So that free withdrawal, if free withdrawals are a big part of your financial plan, then this might not be for you, because this is a fixed period, certain payment stream. You can't accelerate it or take a little bit out of it. But as Curt said, you can get out of the whole contract quite easily. It's administered by this third-party trust company, Gold Star Trust. And I know what the payment stream is going to be. I'll buy it back from people. I buy back regularly from clients I've sold to. And it's not sometimes it's a win for the client. Sometimes it's not. It may not be as much of a win. Depends on the interest rate. I don't have a surrender schedule, but I buy based on current market conditions. So 2 years from now, if we're back in a 2%, 3% rate environment, the people who bought from me this summer are going to be really, really happy. I mean, there's a lot of 6 and 6.5% yield paper that I sold this summer that is going to look mighty fine as rates continue to go back down. They'll make a profit as well as having made the income along the way. So the answer is it is liquid. It's easily transferred. There isn't a specific surrender schedule, but if you pass away and you leave it to your heirs or leave it to your kids or church or whatever, it's easily transferred by will or in an IRA by a beneficiary designation. And then if your heirs decide they don't want it, it's very, very easy to reassign it and to do another transaction. You can say, I don't have any restrictions on that too. Like if you want to sell it to someone else, you can do so.
Very cool. So that answers Alonso's question. Being period certain, what happens if an annuitant dies during the period? Is there a beneficiary? As you just said, yes, there is. And they get the remainder of the payments, just like a period certain annuity, right?
Yeah, the payments. Yep, the payments continue on. There is an aspect of my marketplace that are known as life contingent payments. I just don't play in that space very often. Life contingent payments have a life contingency. The original seller, if they die, the payments would stop. And I've done a couple dozen transactions with those payment streams that have life insurance as a backstop to pay out a lump sum if somebody else dies. But they're complicated. They're a little bit messy. There's a little bit of a yield premium, but in my opinion, there's not enough of a yield premium to make it worth the extra bits of headache. And it's headache for me on the front end as well as for the end customer along the way. Just with a lot of moving parts, it's entropy. Things can go wrong. And it's by and large my clientele, and I think your guys' clientele, we're looking at risk averse, people who's in their later middle age or retirement age, right before retirement. They don't want to worry about it. We're talking about safe money options here. Let's just focus on the safety aspect of it and not try and squeeze a little bit of juice out of what really, isn't enough extra juice to make it work. Yeah. Like I just focus on guaranteed income and guaranteed outcomes, and that's great. People like that, and so that's why that goes to it may be for you if that's what you want.
Perfect.
If you're
looking
for equity,
one more one here is there a joint / survivor annuitant option?
JTWROS. Bob and Mary Smith, JTWROS, and they both own it.
Perfect.
Yeah. But no, these are great. If this is if this seems like something that's of interest to your audience here, I'd love to talk with them. I think, as I said earlier, my company is DCF Exchange, which you can find us on the web at dcfexchange.com, and I'd be very, very happy to help folks out.
And reach out to Curt. Because Curt arranged all this, and he's had a relationship with them for with you guys for quite some time now, and
absolutely.
So we'll just make sure that this is at least suitable, if not put you in a really good position. So that's the idea. That's what we try to do, is help people get better outcomes for having worked with us, or any of the advisors that are watching. Reach out to Curt, and he'll figure out how to get you in contact, because we all get a piece of the pie somehow, in some way.
Absolutely. Curt's been wonderful to work with, and he's going to be a great screen to help understand your clientele, your clientele of the folks who are listening, and see if this is a good fit. And he's used them in a lot of different situations and planning scenarios. So I'd love to work with you. Go through, see what we can do.
All right. Nathaniel, I appreciate you coming on. It's been.
Thank you guys.
I think we'll have some positive feedback from other people that find us here in the next few days, especially on the advisor side and even the client side as well. It's something that, like I said, before we kind of came on air with everyone, was that it's just that market that no one knows about. It's kind of like the way we talk about life insurance. There's things in the tax code that it's been there for 110 years. It's been right under your nose, but no one knows about it.
Yeah, there's some incredible things you can do with life insurance, man. It's you got to know about it, but you got to know that it's out there, and you know that it's an option. And that's where great advisors really add value to people, is that they have a wide breadth of knowledge, and they have an exposure and a curiosity to things. They don't have tunnel vision and say, we only do stocks and bonds and there's nothing else out there in the world. There's a lot of ways to skin a cat, and
Yeah, exactly.
a lot of ways to help people. So thank you. I really appreciate the opportunity to talk to you guys.
And thanks for joining us, Nathaniel. And so I guess we're right on time. We're going to leave it at that. Ladies and gentlemen, you're going to catch us again, watch us again on YouTube and Facebook and wherever else you find your podcasts. Thanks so much, and we'll catch you all next time whenever we do that. So see you later. Thanks, Alonzo, for tuning in. Appreciate your comments. Very good, as always. So we'll catch you all next time. But like, share, subscribe, do the things. All right. Catch you later.